welcome to Coffee with Ardill. Hopefully you have a cup of coffee with you. My name's Ian Ardill, and we're gonna wait just 1 minute while we get rolling here. And we've got some guests, with us today, and we've got our team here. But we'll just give 1 more minute for everybody to jump on board. Well, as I said a moment ago, welcome to Coffee with Ardill. It's an absolute privilege to be with you. My name's Ian, and I'll be your host today. Certainly to all of our clients and friends of clients, it's an absolute privilege to have you on the call today. The format today is I'm going to do a brief introduction so you can get to know our team if you don't already know them, and put a face to a voice or face to a name over an email. And then we're going to dive into our conversation with Juli Booker from Revesco today. And I'm going to have an open dialogue conversation with her about Revesco. And then we're going to do some live Q&A at the end. And so there's certainly an opportunity all the way through where you can be submitting some questions. And we look forward to creating some dialogue with those questions. And we're going to be done at the bottom of the hour. So wherever you find yourself in Canada or other places such as Colorado, I think that's where you are currently, Julianne. We're going to enjoy a great cup of coffee and a time together today. So without further ado, I would just jump over to the rest of the team, and I'll let you guys individually just do a very brief introduction of who you are and your role here at Ardill Group.
Hi, I'm Alejandra Dos Ramos, and you probably know me as Ali. I'm a licensed advisor here at the Ardill Group, and I'm happy to help you with any questions or any support you may need. And I hope you enjoyed today's webinar.
Hey, Dad, it's great to have my dad on board. He actually came into the office today. It's great to have you, Dad.
Thanks for having me in. It's just enjoyable to be part of this. I've heard so much about this investment, and I'm excited to hear more today from our guest.
Amazing.
Hello, everyone. I'm Darlene Abale, Director of Internal Underwriting here at the Ardill Group. I've been with the team for over 17 years now, and I'm really proud to support both our clients and our team, making sure everything runs smoothly and, most importantly, stays compliant. And I'm very happy to be here.
Hello, everyone. My name is Ana Fasolino, and I'm a client support manager here at the Ardill Group. I'm here to support you in any way that I can. I'm the first point of contact for all of you via email, phone call. You can reach out to me, and I will be happy to help you or redirect you to the person that could help you. Have a wonderful day today. Enjoy this webinar. I'm looking forward to this.
Amazing. Thanks so much, guys. Well, Julianne, it's an absolute pleasure to have you on. Julianne, I'm just trying to remember when you and I met a couple of years ago. It's been an enjoyable relationship. But tell me a little bit about yourself, and tell me just a snapshot of your role with Revesco.
Absolutely. And thank you, and to the entire Ardill team for having me, and by proxy, the entire Revesco team behind me. So as Ian said, my name's Juli Booker. Most people call me Booker. I have been with Revesco for 3 years and met Ian along that journey. And my role with Revesco, they really brought me in when the fund was in very early days, because one thing that's wonderful about the team at Revesco is that they know what they don't know. And what Chris and Scott knew was real estate, and they knew it and know it inside out and backwards. What they didn't know was how to run and grow a fund. So that's my job, is to work with Ian and peers of his to help bring opportunities to investors.
Amazing.
But
Julianne,
at the core, Ian, and I will, just so people don't worry that, I'm some fancy schmancy suit. I am just a mom at the end of the day, and I have some kids, and we love to surf, and I'd rather be on the beach than anywhere.
amazing. And where's home for you?
Home is actually Vancouver, BC. So beautiful place. And
where am I talking to you right now?
I know we are at our office, at the Revesco head office that we built down here in Denver, Colorado. That's where our entire team is. And we get together once a quarter, all 20 of us, to plan for the upcoming quarter. So that's what we're doing down here this week.
Amazing. Well, so let's dive in, shall we? Why don't you, Julianne, why don't you share your slides with us, and we'll dive in.
Absolutely. So you want me to just go, Ian?
Yeah, go, and we'll have a great dialogue all the way through.
Yeah.
But why don't you go ahead, and I'll dive in with you.
Okay, so we are Revesco Properties Trust. We're a Canadian mutual fund trust that buys US open air retail. So what you're seeing on the screen right now is a little snapshot of what we do in a Canadian context, so to speak. So these are not our centers. These are actually some centers. I think one's in Markham, one might be in Newmarket. I did look up some around where you are, Ian. So there's a Hill Town Center. So think of these power centers where you're going for daily needs. Where do you grocery shop? Where do you go to the bank? Where do you go to the Shoppers Drug Mart? That's what we are buying in the US right now. Does that make sense?
Absolutely.
Okay, perfect. Now, why would we buy this? People are probably shaking their heads going, Amazon and online shopping and all of that. Well,
yeah, because historically I've always said we don't want to buy retail, and we don't want to buy currently there's a kind of a negative US sentiment. So why? And so I think you're going to address that question.
Absolutely. Well, let's start with the negative US sentiment. I'm as elbows up as anyone. But the negative US sentiment does not come back when you're down here, meaning 90% of Canadians live on the border or close to a border. 90% of Americans do not. What's happening with these trade wars between Canada and the US, it's not affecting the average American the same way. In fact, I come down here and people are like, and my life hasn't really changed. But why we're doing retail, this number right here is why retail. The US economy is the largest in the world, significantly larger than China, which is number 2. 68% to 72% on average of their economy is driven by the consumer, not anything else. So if you're looking at this slide, look at our little economy over here, right, in Canada. So there's just more of everything. Canadians are overweighted in Canada. Our pensions are in Canada. We own our homes in Canada. We invest in a lot of Canadian stuff. That's great. But we are in a position right now where there's a lot of money coming into Canadian real estate, which often inflates price because there's just less of it. In the States, it's 10 times bigger. There's 10 times more of everything. That's really why we're there. Oh, I think Ian froze.
No, I'm here.
Oh, okay, perfect. So I think this is what we were kind of talking about, is what we're seeing in the news, right? It's always just bad news bears everywhere, but good news doesn't really sell newspapers, or I guess now we'd say get the clicks, right? So let's talk a little bit about what's behind those headlines and what we're really seeing. Retail sales are actually up significantly year over year. What we're finding when anytime the economy has a shift or we're going through a cycle, it's that people don't stop spending, but they change their spend. And this information actually comes from McKinsey, which is a great polling company down here that did that pulled 25,000 people in the average household income, which is about $60,000 to $80,000 a year in the US. So they really targeted the average person as much as they could. 50% of people, if over 50% of people said they're going to stop discretionary spending or cutting discretionary spending. So they're not going to maybe go out for fancy dinners, or they're not going to go on trips or buy a new car or renovate their home. But what they're not changing is where they get their food, where they buy clothes for their kids, or maybe they're going to trend down, right? People go from shopping at Nordstrom to Winners faster than they go the other way, right? So when we're focusing on these daily needs, high credit, mid-tier retail, that's the stuff that sticks around. Make sense?
Absolutely. We got to survive.
We got to survive, right? You still have to eat. So this is one of the things. So Ian, you and I have gone back and forth on retail and the US a lot. I always love our discussions because they always have some good debate in them. So my thing was, I'm going to find, and when I say I'm going to find, I mean Lauren, who is our amazing marketing research person, is going to find some information about how retail has performed in the US against other sectors, specifically since COVID, because in COVID, we all thought everybody's going to go online, everybody's going to buy everything. Peak of COVID, 16% of sales, of all retail sales, were done online. Peak of COVID, that means 84% of people were still going out to get what they need. Because I know if I'm putting it in my family's body or I'm putting it on my kids' bodies, they're going to need to try it on. I want to know what it is, feel it, touch it. So since COVID, retail has had one of the least, that is the only commercial real estate group that has had the least amount of decline. Comparatively, if you look at multifamily and office, of course, where we have seen a lot of trouble over the last 3 years. A big part of that story is the debt story. When money was essentially free during COVID, you're getting these mortgages on office buildings or multifamily buildings, you're leveraging them at 85%, and your mortgage coupon is 2%. Well, within a year, those coupons went up to 6 to 7%. People got upside down, they couldn't afford their debt. So that's a really big part of this.
And Julianne, I think one of the biggest things, and I'm wondering if we can jump into this one.
Yeah.
I think you have a slide having to do with like how much money has been going into the development of this space. So because I think here's what I think is really the driver, and I'm wondering maybe, and I don't want to steal the thunder, but I'm thinking like a savvy investor is investing and buying things that are going to have value in the years ahead, and ultimately when you look at investment dollars and where they have been chasing, it's been chasing these more shiny objects like a multifamily and like industrial and other things that have had a little bit more traction to it. Where dollars have not been flowing is into the open air retail space. It's been, if anything, it's been leaving that space. And so therefore there's been no new construction, and there's really a fairly strong attractability, not so much in closed retail, but in open retail where you're doing the your standard life stuff like groceries. There's certainly a really strong performance, and where you guys fundamentally believe that there's some really strong future performance. Is that a fair statement?
That is absolutely a fair statement. You know, Chris and Scott have been in retail for over 30 years, and they've always done this, and they've always made money at it. They've lived in a world where for those last 30 years, they've seen vacancy rates on average in retail sit at about 10%. That's kind of where it sits. It has the lowest vacancy rate of all major commercial real estate sectors in the US right now. This is CoStar. This is an outlook for Q3. You know, we're seeing in most of our metros that we're invested in, sub 4% retail vacancy, even industrials coming off a little bit. And you're right, it has been completely underbuilt, way overbuilt in the 90s, mostly enclosed malls. And now we're seeing those, I think the statistic was around 100 enclosed malls are being demolished every year or repurposed for different uses. But it's so hard now to build this type of product with the lack of skilled labor, with the costs of construction going up. And we really believe that with Mr. Trump's immigration policies, skilled labor is going to become an even bigger issue in the US before it gets better. So we're really in this, we're at this inflection point, and I do have a slide here to show it. So you can see here that we're talking, this is open air retail. This is from Green Street, which is, an up to the minute, the best, everybody in real estate uses it in the US, data provider. So basically, if you look, this gray is in millions of square feet, what was being developed in the early 2000s, right? Right now, they're saying this year, their initial idea was that they were going to complete on about 13 million. That's now trending to sub 10 million.
Yeah, 13 million square feet. Yeah, okay.
Exactly, of development, right? So now we've got this crazy low vacancy rents, and as a consequence, and especially since the pandemic, rents have gone up 19% in retail since the pandemic. So I think it's just a testament to what we're seeing and what we're heading into. The less space there is available, the more rents are going to increase. And the reality is that if I'm going to build a new building, it's going to cost me $500 to get it out of the ground, a foot. We're buying these buildings for sub $300 a foot. And that's, ready cash flowing on day one. There's a lot of space for us to grow rents before a new build could even come close to it. So if let's use TJ Maxx as an example. That's Winners, HomeSense, Marshalls, Sierra Trading. They have a couple other brand names here in the States. But Scott Lee, who's one of the partners, has done over 600 leasing deals with TJ Maxx in Canada. He brought TJ Maxx. He's done, if you've ever been to a Winners, HomeSense, or Marshalls, that's Scott Lee or one of his team members. They've opened every Costco in Canada. They opened every Target in Canada. They know how to find good real estate and where these types of retailers want to be, right? So that's where they're focusing on it. So they know that if Winners is paying $12 a square foot in the building that we own and the big shiny new one across the street, that landlord can't offer that at $12 a foot. It's going to be over 20. Why would Winners move for that and give that away when they've got that base? So that's really what we're looking at. We just see a ton of growth coming up.
Awesome. So I love the macro theory, and certainly as you have questions, feel free to type them in. But I think I'd love to dive into kind of the, how are you filling this gap? Because I'm understanding the opportunity. What is Revesco doing about meeting that opportunity?
Yeah. Great question. So we are looking for shopping centers, open air shopping centers that are anchored by really good credit. So you're looking at this side here. These are just a few of the 75 retailers these guys have represented over the years. So anytime we see one of these names in a lineup, the more of these names we like, because two reasons. We know they're strong centers because they've got national credit, and two, we can get detailed information on them because we have contacts here. We can get sales. We know the health of the store, right? So that's what we're really looking for. And then we go and we work our magic, which is, oh, there's vacancy here. Well, guess what? We've been leasing for 30 years. That's an opportunity. We look at markets where other larger institutions would overlook. So secondary, even tertiary markets where there's, a college town or an airport, a small airport nearby, anything where there is density. The thing about retail, Ian, is that it's kind of agnostic to where you are. It doesn't really matter where you buy it. You're looking at these things. Where's the high income? Where's population growing? Where are the educated people living? They have more room to make more money. And what's the cost of living? So we're looking for these little special pockets where you can get these properties for under replacement costs that are already cash flowing. And then we're going and making those better.
Well,
essentially.
Julie, if you go back to that slide there, I think it's really kind of one of those things that I oftentimes think about when I'm in the U.S. You have this in Canada, but I find it's more dramatic, at least from my experience in the U.S., where you drive through one town or one city and you're like locking the doors and you're trying to like put your foot in the pedal to get through that city as quickly as possible. And then you go into the next city and it's like, wow, like this is amazing. I'm ready to move to this community. It's a very, very dramatic. Fair?
Very fair. So,
and so where I think you guys have done a really interesting job, and I know you've talked about this, the team like Chris and Scott have talked a lot about this, is that you guys are very agnostic in terms of, you're not just trying to buy real estate anywhere. You're trying to be very strategic in terms of, where can you find the up and coming communities? Where are those communities that aren't just, strong today, but are in a growth pattern with the right kind of population that are going to drive the sales of those retail spaces? Is that a fair statement?
Absolutely, because those pockets, and I always just take it back a step. Like everybody that's listening on this call right now, where do you go to shop? Think about that. Do you drive 45 minutes out of your way unless it's like a Costco or something? But then if there's a Costco, you're probably going to stop at the surrounding areas there, right? Retail is a 3 to 5 mile story. How many rooftops? How much money are those rooftops making, and are they growing, right? We often look at areas like drive till you qualify. Atlanta's a really good example of that with Roswell Village, right? It's north of Buckeye. Buckeye's got a lot of money. People can't live in Buckeye, so they're just going to drive till they qualify in Roswell. These people are still making $130,000 as the average household income. That's almost double the US average. That's just good for retail. That just means there's more disposable income, right? So we know what's going to draw people into these areas, right? And then we can go in and execute on the business plan. That's the big piece that you really have to do, right? You have to know how to lease quickly. Have to know how to restructure leases so that we can put in annual rent increases, so that we're working, we're matching to those to inflation. We're improving tenant mix. What does that mean? Well, we have a gym at Roswell with 8,500 members, and we don't have a physiotherapist or a chiropractor or a juice bar, right? We try to find tenants that match each other and curate these lifestyle centers, like you said, that are going to meet the needs of the community. We want us to be our centers to be the dominant shopping center in any given trade area.
Outstanding. I think one of the things that I found interesting is Revesco, I think, is really should be thought of as a long-term play, because one of the things that I was asking you, Julianne, is like, I had clients with you for a year or something like that. I'm like, where's the return? Where's the return? And it was fine. Like, there was nothing bad. But it was like, oh, it's, you're not, if somebody wants to get something that flies off the page, it's something like amazing. Probably Revesco is not it's not going to perform like a penny stock or a high, like an AI powered stock on the tech market. It's going to be a long-term play where you're buying really good quality real estate where you might have existing tenant holders, and it takes a while to flip those tenant holders over and put the appropriate market rent into those leases. But the important thing is, I think it's interesting you mentioned this. Like, when you buy an asset, it's cash flowing day one.
Yes.
And you're looking for the properties that have significant market gap, where you go, hey, we have a vision for this real estate. We think we can take it from point A, and we feel like we can take it to point B, and it's really exciting.
Yeah, absolutely. And, for the 20 deals that we look at every week, we maybe underwrite 6 a month, and we maybe bid on 1, and we maybe buy 2 a year, right? Like, this is how, and I really do think it, and I give the partners a lot of credit. They have 10% of the equity in this fund, right? They're over $6 million US of their own personal capital sitting beside the investors, not treated differently, still getting the same 6% annual distribution. And they think that's important for alignment. We all participate as employees. That's important for alignment. So the fact that they're putting their money in this, and we're getting money put in this as part of our plan, we need this to succeed. This is all of us. And that's what I really love about the team, Ian. There is no bureaucracy at Revesco. We are small, we are agile, but there's not a hierarchy. We are what needs to get done. We can be agile and we get it done. But you're right. This isn't going to be, you're not going to see a 20 cents lifted NAV every single quarter. It's not going to happen. We are doing big leases that are worth a lot, right? You and I have talked about this before. Apartments, great. You renovate an apartment, you get an extra $100. You renovate an apartment, get extra $100. At a 6 cap, that's adding $10,000 in value to the property. That's great. Those are incremental, it's slow. But those leases are only good for a year, right? We might need to wait 2 years for a space for us to come up, but we're not making $100 more on that lease. We're making $100,000 more, which is, a $2 million increase in the value. So it's a staircase, right? You'll get pops, and then you'll be flat for a long time, right? We're doing a ton of leasing right now. We're going to be flat this quarter, maybe even next, because those leases don't hit our books till the beginning of 2026, right? It's longer. It's 6 to 8 months to lease it. It's 6 to 8 months to build it out. But now you have that lease with incremental rent increases for the next 10 years, and you can sit back and relax.
So let's talk about the portfolio. Let's dive in there. How many properties currently do you have in the portfolio, and what's the gross value or market value of the current assets under management?
Yeah, so we are currently 173 million AUM, and that's across 7 properties. We just acquired Sundance Plaza a couple weeks ago in Steamboat Springs.
So if you're an investor, does it come with a free trip to like to Sundance and to come check it
Wouldn't
out?
I love that? Well, just, they do have a little airport in Steamboat. Wouldn't that be nice? Just
These
get us a
like I would
private
like to have
plane.
a trip to Steamboat, but maybe I could use 5% of my cash flow or 6%. So talk to, so sorry, I'm
No,
jumping
no,
ahead of
no.
myself. Okay, let's
So
stay
yeah,
with the
I'll
properties.
take you through some of our properties, and they're all going to look a little bit different, right? And there's a reason for that too. Kind of retail comes in all shapes and sizes, and even within the fund, we want to diversify, right? So this is Preston Place is a power center in Louisville, Kentucky. There's not a lot of, we've got 4 tenants, but we added a pad. This didn't exist. The scooters didn't exist. We built that. So we were able to increase the NOI, increase the density. This thing is 100% leased. It's got annual rent increases. This is a bit of a set it and forget it. Preston Place is just good value. As the market comes back, this would be one of the ones we would turn first, just because it's spitting out good cash flow, but we're kind of done there. There's not a lot of ways for us to grow that value anymore, right? Fort Collins, Harmony School Shops. This is a beautiful property. We've already spun out one pad on this earlier. We said it sold off the Comfort Dental. We love that about retail too. You can spin off these little pads here and there. We have a great opportunity here. We do have one dark space. Office Depot went dark a couple months ago. We have a Spirit Halloween in there for the next couple months just to keep some rent coming in, but we're going to find a really good user for that space. And it's a big space, so it takes longer, right? The bigger the space, there's not a lot of 20,000 square feet users out there, so it takes a bit longer. But then, at 10 or 15 bucks a square foot, that's a huge influx of cash flow. And we love Fort Collins. It's in our backyard. This is our trophy asset, right? This is the one where we said, you know what? We can't buy grocery anchored shopping centers right now because the institutions are buying them all up. So what are we going to do? We're going to create one. We bought Aspen Place in 21. The end of last year, we bought the adjoining Whole Foods. It was a separate owner. And now we've created a grocery anchored shopping center, the dominant center with Lulu and REI and all these great top tier retailers. We just signed Free People's going to come here. We're talking with Anthropologie and Sephora. These are really big names that are wanting to come here, and there's a lot of discussion that goes into that. But just by adding the Whole Foods in, we lowered the cap rate on this property by 100 basis points.
Outstanding.
It's going to go off at, we've put 44 million into this property, all in with the Whole Foods. We just got a valuation, a broker opinion of value for 56 million. It's real. These are real things that work.
Yeah. So loosely, like that's a 20% return, just if you're following the logistics and the math on that. So
exactly.
And that's not even talking about the cash flow. That's just the asset growth.
That's just the asset growth. And we've been paying our 6% a year. We've never missed a distribution. We pay it out. You're getting paid to wait. We're paying you to say, wait for the good stuff because it will come. This is in Phoenix, Arizona. We love this area. We're getting some good pickup. We're looking at building a pad out here. We're talking to Panda Express about that right now. Fitness user, Planet Fitness, national tenant. We love it, right? So you can see they're all a little bit different. Bozeman is more just retail, mixed use. There's some office up top, but this is 100% leased and spits out cash beautifully. So we have no issues.
So I just wondering, just for sake of time, and I know you've got a slide for all of your properties, but I'm wondering if we can jump into kind of the metrics of the investment. So an investor is invited to jump in with what dollars? Do they need Canadian dollars or US dollars?
Either and.
Thank you. And so the, one could consider a investment in Canadian dollars with a layer of risk, but I see it as a potential of a layer of benefit. And I'm wondering if you can explain that. Why, like, what if somebody took Canadian dollars and they invested in the fund? How are those funds showing up in U.S. real estate? Like, explain that metrics and how might that affect our value as we see a monthly fluctuation on our end as an investor?
Absolutely. So the fund itself is all based in US dollars. We have a series that Series C, you can come in with Canadian dollars. It's a $15,000 minimum, can use your registered accounts. What we do then is on the closing date, which is always or generally the last day of the month, the last business day of the month, we use the Bank of Canada spot rate to do the conversion. So we say your $15,000 Canadian is equal to X in US dollars, and you're buying it at $9.35 US. So the risk is that you buy when the dollar isn't great, and then the dollar picks up, and then you're down a few pennies, right? But overall, if you're thinking, and I want everybody to be thinking, this is like a minimum 5-year hold. You don't want to get rid of this before 5 years. But over that 5 years, that kind of balances out. You win, your wins are going to balance out with your losses. It's like trying to time the market. It's impossible, right? Time in the market beats market timing every time, right? So, there is that little bit of risk. And, we saw it last quarter, right? Our NAV stayed flat, but when we flipped it to Canadian dollars, it looked like it had gone down. That's not real because you're not selling that at the time, but it was just because of the dollar, right? So you just have to be prepared for that. But know that we always say, this is the US dollar now. This is the value. The exchange rate is just, that's out of our hands. And we don't do arbitrage.
So yeah, I think that's one of the biggest things that I think is actually a benefit is, as a Canadian investor, when we look at deploying capital, we're always looking at diversification. And so, we're diversifying ourselves because we're buying into the US, but we're also buying US dollar-based assets. And so, if the US dollar, somehow takes a real nosedive over the next 5 years, is that going to negatively impact our overall return? The answer is yes. However, the flip side is also true. If the greenback has some really strong macro performance beyond Donald Trump, beyond his current term in office, and you think, hey, like, is the US dollar going anywhere? I would argue no. And on a macroeconomy basis, could it be down or up in any given quarter? Yes. But I think from a diversification standpoint, having things based in US dollars, even while you're buying it in Canadian dollars, is great. And so the best way to describe it is, if you have current US dollars as an investor, invest in US cash. Great way to deploy that capital. But if you have Canadian dollars, you don't have to pay for the conversion. You get US based assets without having to pay for that conversion. And so that's why I still think it's a great deployment. And I'm not super concerned about whether the US dollar is going up or down. I think on a macro basis, it kind of actually further diversifies one's portfolio. Is that?
I couldn't agree more, Ian. And really, we were just down in Mexico meeting with some investors in Mexico City, not last week, the week before. I think I talked to you in the airport, actually. And I was saying to you how similar Mexican and Canadian investors are. Very different to the US investor, who is very much thinking about, I want that quick payoff. I just want to get my money and then go spend it on something else. Canadians and Mexicans are much more, I'm building wealth. I'm creating wealth for the next generation. How do I protect that wealth? And they are just trying, like us as Canadians, to get their money out of Mexico. They don't want everything held in pesos because it fluctuates obviously more than the Canadian dollar, but we've had a lot of ups and downs. So, the reality is the US economy is still the strongest economy in the world, whether or not, we like what's happening. We agree with the president, which I don't, for a lot of reasons, but the people, because the consumer is still the driver of that economy, people can actually keep it afloat. It's so different than Canada.
So here's what I've got about 5 minutes before I
Yeah.
want to flip into questions from our audience. So what I'm going to encourage you is on the bottom of your screen. Unfortunately, we have a number of bots that joined our call, so I disabled the chat. But the Q&A, you can still chat in the Q&A. And so if you're listening feel free to jump in and post any questions that you might have, and we'll get to them in about 5 minutes. But one of the things that I'm just going to dive into is to say, like, just so we get the metrics of this, right now you're paying 6%, correct? And the
Correct.
intention is that you would continue to pay 6% yield on one's investment. And that 6%, if you're registered dollars, that obviously shows up in the registered accounts. But if it's unregistered, tell me about how it's being taxed currently.
So right now, if it's unregistered, it is a return of capital until, you hit your adjusted cost basis, which is usually at around 96, 97% ROC. And then after that, it will be capital gains. But like I said, you're getting that 6%. It's going to take you a while to hit that, even get to capital gain territory.
Yeah, and for simplistic math, it's the most tax efficient way to generate a return on an investment. So okay, so you're getting the 6% yield into our pocket, and certainly for corporate dollars, this is super efficient. And then when we get that cash flow, that's not tied to, it's not like a withdrawal from our equity. That's essentially our fair share of the rental yield. And
That's
then
exactly it.
And then you've got this equity play that's theoretically can go up or down based on macro performance of the portfolio and the USD, which we've already talked about. But ideally, on a holistic level, what's your kind of, again, past performance can't be a guarantee of any future performance, but based on where you see things going, even on a conservative basis, where do you see yourselves going, or when you model things out, where do you see yourselves being in the next 3 to 5 years?
Yeah, so our targeted annual return is 12 to 15%. It's right on my screen right there. Historically, we've averaged 20 a year. When we're looking at a deal, and I'll just use Sundance Plaza because we just closed on this, week and a half ago. Everything is separate. So for this one, we're looking at a target hold period of 5 years and an IRR of almost 18%. So we feel really good as these properties are turning, and we're 3.5 years in now to the fund. Some of these properties are starting to mature in the next 2 to 3 years. We're feeling really good about hitting that 12 to 15%. Obviously, we want to under promise and over deliver. That is by our nature, just because we're Canadian, and I think everybody is a little bit more conservative up here, and we really care about our money and our investors' money. But that's really where when we are looking at each deal, underwriting each deal, most deals underwrite between a 15 and an 18. The odd one up, the odd one slightly lower, but we might really like it because it's got really good cash flow, or there's a lot of vacancy that's free and we know we can lease it up, right? So it's it's a very delicate, how we mix and make sure that we're achieving the returns and putting the right assets that we need in the portfolio at the right time.
Awesome. And lastly, in terms of macro performance, I think one of the things that I just want to reiterate, which you already touched on, is this is a 5-year hold. It's not meant to be buy it and liquidate it. It's really designed around holding it for an extended period of time and reaping the rewards for being a long-term investor, because ultimately you're not taking that money and putting it into an ETF. You're taking that money and you're actually buying these hard assets and accreting value. Fair?
Yeah. And I'm marrying a trader, and I don't get it. I can't touch it. I can't see it. And I'm like, at least I own bricks and land. I don't know what this means, but that's, a comfort level thing
Totally.
for everybody's different, but yeah.
Thanks, Julian. So I'm going to, without further ado, I've got a couple of questions
Wonderful.
coming in. And so I thought I'd just dive in with a couple of questions. Have you had any investments that you've struggled with, and how did you deal with that?
Such a good question. We were actually saying the other day, we wish we got more. We wish we got more like this. Every investment has its challenges. We had a deal that we made about 8%. We did an 8% annual return to our investors over 5 years. That's our biggest loser, let's say. And it was a learning experience. So we had CNBS debt, which it's really hard to get them to approve new tenants. So we lost a couple of tenants because that. In retail, anytime you sign a new lease, you have to get your lender to say, yes, we approve of this, because they're banking on that credit to get their payments. CNBS, very challenging. So we lost a couple really good leasing opportunities there. So at the end of the day, even though we didn't complete our business plan and we sold that space with some vacancy, we knew that once the loan was up, the best thing for us to do was sell that, get something to the investors. We're not going to lose any money. We're going to put some money in our pockets and their pockets, and then put it into the next deal that's better there, where we don't have this debt that's kind of making it impossible for us to execute our business plan, right? I mean, we've had floods, we've had fires, these things come up. That's why we're headquartered in Denver, so we can be on site right away, anytime. One story I will share is really quick. During COVID, all the big retailers stopped paying rent. And you talk to the real estate people and they're like, listen, I can't do anything about it. I've been told this, but hey, since you're my friend because we work together, if you write a letter to legal, then they'll take it. We collected every penny of rent after COVID. It took us about a year to close out all the AR, but we did it. So it's really just that ability to say, if there's a problem, we don't turn our blind eye to it. Again, our money's in this, right? So it's just figure it out, fix it, and be honest about it. I think that, stuff happens with every investment. Things
Awesome.
are going to come up. It's about communication.
Great question. So, or a great answer. I've got a bunch of other questions here, so we'll kind of keep them short to the point. What do you see as the largest risk at the moment in time, or like exactly what the question was, what do you see as the largest risk categories? And I think the question is really around from the fund perspective.
Yeah, so debt is our biggest risk right now. Over the last 12 months, a ton of money has actually started to come into retail. So people are, the pricing is increasing in some places. And with rates still high, cap rates are still compressing for some reason. I don't understand it. It's kind of upside down. So our biggest risk right now is that we won't be able to purchase high quality assets with the leverage that's out there, because they need to cash flow, right? If your cap rate is inverted to your mortgage rate, you're not making any money, right? So that's a risk right now, but we feel pretty confident about where rates are headed, and we're getting lenders to the table. A year ago, we could get 4 bids on a loan. For Sundance Plaza, we had 19. So, you kind of
Wow.
watch what's happening
Got
in
it.
the market.
Got it. Thank you. One of the things that I think is interesting is the way you have alignment. In a lot of funds, you have a high watermark. And so again, you have the cash flow of 6%, but in the fund structure, you have a high watermark, and then you have a performance bonus that goes to management. And you might say, well, that doesn't sound very good. But what it does as an investor in Revesco is it creates greater alignment. And I'm wondering if you can just talk about that structure, and how that ultimately creates great alignment from an investor standpoint.
Absolutely. So, there are funds that are just a straight 80-20, whatever it is, everybody gets their piece. What we're saying is we need to make you 7% before we make anything. And then we're going to split that balance with you. 75% goes to you, 25% comes to us. So say this year we get you 9%. That's great. We're going to take part of that over 7%, right? If next year we don't hit 9%, that's the new high watermark. So we don't get to participate again until we get you that 9 or up. And then if we get you an 11, it's the same thing. So we have to keep pushing those returns, and we don't have a catch-up policy. We don't say if we don't catch up within 2 years, right? If we get you an 11 one year, and then for the next 4 years something tragic happens and we're only spitting out a 7, we're not taking a piece of that pie because we haven't hit that high watermark. So I think that between that and having everybody's money in this, it just makes us all working really hard to make these things go off and be successful. Because without those fees, that management fee, that performance bonus coming in, like, we're not winning at all, right? So I love the way it's set up in that respect.
Amazing. It's wonderful alignment. So thank you. Okay, one of the things that's oftentimes on questions' minds, particularly right now, because there's certainly issuers out there in the real estate space that are having difficulty managing liquidity from the perspective of redemptions. So if you were to have an environment where you had significant redemptions on being asked of you, talk to me about what that looks like for Revesco.
Yeah, that's another great question. So, in the OM, we have to be able to redeem up to 5% of all the equity in the fund if we have the cash, right? The way that we are ensuring that we have that availability, should there be a run, is that we, instead of having a traditional mortgage on one of our properties, we actually have a line of credit. So that allows us to make sure that we have liquidity, at all times, and that we never have lazy money either, right? If we need to pull on that for an escrow, or if, people get sick, people pass away, people get divorced. Like there's a million reasons somebody would redeem. But that's our protection in place there. You know, if we ran into a time where we couldn't handle redemptions, I'd be surprised. But I also, you know, there would be a note if there was a run and we only could pay out 5% of the total equity, you'd get a note and you'd be in line, right? And that's standard again. But having that line of credit makes it so that we don't just have cash sitting idle in the fund, because that's a kiss of death too, right? People struggle with redemptions, but you also don't want, you know, these funds sitting on tens of millions of dollars.
Totally.
That's
I
not
mean,
working.
the catch bait, the thing that I like about you guys, and, you know, the funds that we work with, like you, is that when dollars go in, they don't sit around.
No.
Like you have places to put them to work immediately. And because as a shareholder, money that's sitting idle is not good for anybody. And so what you want to do is strike a balance between creating liquidity and creating the ability to see dollars put to work immediately. And so, you know, under normal circumstances, certainly in your fund history, you've never missed a distribution, you've never missed a redemption request, and certainly we appreciate that.
Good, I'm glad.
You know, again, I'm coming, we're coming to the bottom of the hour. So I've got a couple more questions just to ask quickly. This one is, the question is, what do you see as an average appreciation over, my screen unfortunately is cut off here. Over the next 10 years. So what do you anticipate as the average appreciation over the next 10 years?
I mean, that's a huge question. And fortunately, I don't have my crystal ball in front of me. And I wish I could answer it perfectly. Why not? Exactly.
Booker, I want GIC answers here.
Right? GIC answers, GIC risk. No, you know what? It's a good question. We index our appreciation in rents at 3% a year. That is kind of our flat expected underwritten thing. And that's because that's what we have going into the leases. It really, again, is super market dependent, right? So, you know, if we average, you know, 3 to 4.5% increase a year, that would be beautiful and consistent. We're going to see years where we don't, and we're going to see years that are bigger. Couple things that are going to take that into consideration. If you go from having a strip center that has a cannabis store, a privately owned liquor store, and a little nail shop, and then you put in a PetSmart, a Winners, and a whatever in the corner, a Subway, sandwich shop, a Whole Foods, right? That property is just more valuable because it has better credit, right? So that's where retail, it gets, so it's hard to really say. It's like, if we do our business plan correctly, then we should be increasing the value of these properties about 4% a year on average.
But I think it's missing the larger scale conversation around really, to me, the nugget is you're making tangible changes and improvements on properties. When you've maxed out the improvements on those properties, you're churning them. And so you're liquidating and capitalizing on that maximum return. So currently you have 7 properties in the mix. And in the next 3 to 4 years, the intention is that you're going to be selling some of those assets and adding more, right?
Absolutely.
So like all being well, you'll have, you know, 14, 15 properties in the mix, and well have exited a number in the process as well. So I think that's where you're getting that differential of getting that lift in the value appreciation, you know, using that one example where we were talking about a 20% lift just in the equity of that plaza alone, that's kind of where we're trying to see that growth. And so that's where you're getting that conservative number of 12 to 15. I'd love to see it a little bit higher. It could be a little bit lower. This is not, again, a GIC return, but again, the overall return is, tax efficient returns based in US dollars at a 12 to 15%, targeted return. So Julianne, thank you so much for your time today. There's a few questions that we didn't get to, but certainly our door is always open. I always am thrilled to chat with you. If you're a current client or a future potential client, I'm here to help. Our team is here to, would love to kind of book a time to chat with. And even Julianne has been so gracious to us. She's kind of said to us, our door is open and we'd love to have you a part of any dialogue that a client's looking to have. I'll leave the closing mark to you, Julianne. Any last closing comment?
I just want everybody to walk away and think about where they shop and think about how much of your wealth is sitting in Canada right now. And is that the best place for it all to be sitting? So just some things to ponder on.
On behalf of the Ardill Group and our sponsor today, Revesco, thank you. And for those that were able to attend, we're going to be sending you just a small thank you, a cup of coffee at Tim's. And so on behalf of everybody here, thank you. Have a great one. Bye-bye.
Bye-bye.